Okay, we are live. Okay, welcome everybody. My name is Gavin. Welcome to another Alphachain webinar. This is your weekly market brief. It is just gone almost 8:20 a.m. It's the 25th of July, the final trading week for the month of July. So let's get straight into it. So coming off a week that was dominated by the surprise 50 basis point ECB rate hike, all eyes are likely to turn towards the Federal Reserve in the days ahead, as we seek to sort of ascertain whether there will be an oversized rate hike of 100 basis points. That's a 1 full percentage point rate hike potential there. Now, these outsized rate hikes that we're seeing of 50 basis points, 75 basis points, even a 1 full percentage rate hike, these oversized rate hikes that we've not seen in decades, is now becoming the new norm. It's becoming the new norm as we have these elevated inflation levels, and just trying to tame these inflation levels is becoming a little bit more difficult than they had assumed, the central bankers had assumed. And therefore, they need to now get ahead of the curve to be able to rein in the inflation levels. So today provides a slow start to the week from an earnings and an macroeconomic perspective. We have the German IFO business climate data. We also have some figures from UK corporations such as Ryanair, providing probably the main focus in the European session this morning. However, with a week jam-packed full of economic and corporate releases as we head to the month end, this represents just the calm before we expect the storm, right? So let's get into some of the charts that we want to sort of focus on. Before I go into sort of the euro parity as well as what happened in the previous week, let's just start with the financial. Okay, so the monthly fund manager survey that is released by the Bank of America each month, right? That's released each month. That gives us a great insight to where these fund managers are positioned. And what we're seeing from that report, from that survey, that the cash holdings of these fund managers are at their highest levels, going back to, we're going back to many years, almost 2007 to 2009 sort of period levels. Okay, so yeah, so somewhere between around those levels, 2007, 2009 levels, and the equity exposure are at its lowest level since that period as well. Right? Since the global financial crisis and the recession that we saw in 2008. So clearly we're seeing that fund managers there are weighting more towards cash and holding onto cash, not making those decisions of where to allocate those capitals, that capital, whether it's into equities or whatever holdings might be. So yeah, it's clear to say that there is still, fund managers are still waiting for that inclination where the markets are going to recover and come out of what we see in the most recent lows. And in the previous week, we did end the back-to-back sell-off that we've seen, right? The week-to-week sell-off that we've seen. But overall, the pessimism is still around. So I don't want you to just assume, just because last week we saw most of the trading week being in a very optimistic way, in regards to sentiment, but overall, the monthly fund manager from Bank of America states that these fund managers are clearly holding on to cash, and the equity exposure is at its lowest level since the global financial crisis of 2008. Yeah. So this can be viewed as maybe even a contrary sort of indicator, meaning that there is plenty of cash to be put to work with possible moves from underweight back towards neutral equity exposure as stock markets begin a rally. But the question is that have we formed the bottom, right? Has that bottom been put into place? And we're now in in a new bull run. That is for you to take on board, right? That this is the information that I will share with you so that you can go on to make your own trading decisions for the week ahead. But clearly, we know that fund managers are positioned mostly in cash. So just look for quality rather than quantity, right? So quality matters at this stage, what you buy in regards to deploying your cash into sort of allocating it into a portfolio, right? Right. So before I head into this, actually, so what I also want to touch on is last week, I think one of the key changes in the theme from, from a risk-off, fear in the markets, earnings are likely to come in worse than expected. That was the fear, right? So the fear was that these earning reports were not going to be in line with their expectations. In fact, they were expected to be sort of downgraded, right? But overall, it was a more robust start to the earnings season. Okay, we're in full swing now. We're definitely in full swing now when it comes to earnings season. But certainly the first week's worth of sort of earning reports, it wasn't as bad as markets expected. And that can be put down to maybe having a look at Netflix. So we saw Netflix trade from those lows around the 170 mark, around the 170 region here, right? So it's often sort of tested this 170 handle. That's probably sort of a key level of support. And from that point, it's rallied all the way up to 220. Okay, so 220 a share. Just looking at sort of taking it from around the 170 mark up to where it is now, that's nearly a 30% gain. So we've seen a 30% gain from its lows. And that's Netflix price. So just to give you an idea, they had lost subscribers, but it was less than anticipated. So that's the sort of, pivot that you've got to understand, is that it's not just about, whether it's a poor number or a positive number. Yeah. So it's not just that, whether it's positive or negative, but it's market expectations. If market expectations were of a larger amount of losses in their subscribers, but they actually have less than that, right? That's actually quite a positive. That shows that, okay, even in these tough conditions that they're in, they are still not as bad as what we anticipated. So Netflix, it's reported, it also gives us forward guidance that it anticipates for Q2 that their growth in subscribers will resume back to normality. That's what they suggest anyway, right? So yeah, earning reports last week came in robust, not in line with those very pessimistic market analysts' guidance. So that led to the first 3-4 days within the week to trade in a very bullish outcome, as you can sort of imagine, as we've seen with the Netflix share price rising almost 30%. Looking at, if we look at the S&P 500, if we're looking at the sort of daily time frame, we can see it's trading in quite a bullish, optimistic way. It's broke out of the prior highs, so it's broke through the prior highs, going on to sort of test the 4,000 mark, holding some resistance at the 4,000 mark. Okay, so the major US, if you look at US stocks, major US stocks, the averages, indexes, certainly were higher last week, even though on Friday it pulled back. We saw a bit of a pullback on in Friday's session. Now, the key question is, has the bottom been put into place, and are we looking at a new rally, right? For that to be confirmed, you need a series of high highs and higher lows. That's what I'll be looking for, a series of high highs and higher lows. We've just got the first breakout of the high. Okay, so we've got the first breakout of the high, right? So we've broken these consolidative sort of previous highs that we've seen that was met twice. We can almost see that Nasdaq achieved, just crossed above the 12,600 before it pulled back, and we saw the S&P 500 break those highs and also test the 4,000 before it's pulled back. The question is, are we going to look at the next dip and then a new high come into place? That's what I'll be looking for, so that the sentiment continues to improve and we start to see the series of higher highs and higher lows that we expect a bull run to have. Yeah, but don't rush into it. Don't rush into it. Yeah, so we've got some significant resistance barriers ahead. Okay, as I mentioned, the 4,000 figure for the S&P 500 is a strong psychological round number, and it's a very strong resistance level. Okay, so this, so just be mindful of that. That reinforces these bases from those June levels that were met, but you can still wait for the breakthroughs. Yeah. The key event for the week ahead, as you already know, is the Fed rate decision, right? So we know that the rate decision is taking place this Wednesday. Wednesday is the 27th. So the 27th of July is when we expect the rate decision to take place. UK time, it's usually around 7 p.m. to 7:30. Yep, so at 7 p.m. with the rate decision, 7:30, we usually have a press conference that takes place. Now, the rate decision is going to be made by the FOMC, which is the Federal Open Market Committee, right? And what happens is there will be a 2-day blackout meeting that will take place, which takes place from tomorrow, Tuesday. So Tuesday and Wednesday, they'll have a blackout meeting. And this is where they discuss all their all the key variables in regards to making that decision of where they would like to see the rate decision at this current moment, based on all the incoming information. And what is market expecting? Market is expecting, well, the vast majority of the expectation is at 75 basis points. So we're expecting a 75 basis point rate hike. But recently, as we've seen these surprises from central banks, right, of raising rates much greater than anticipated, there is a small possibility that we could see the Fed raise rates by 100 basis points, so 1 full percentage point. Now, the reason why that's been priced in is that overall, some elements within their US economic activity that we're seeing is not so great, but overall, they are still faring much better than other economies out there. Okay, so their labor force is quite a strong one. So that's one of the key drivers there as well. So just be mindful in regards to what to expect there. Certainly 1 4% rate hike is possible. It's on the table. It's a potential, but the vast majority are expecting 75 basis points. Okay. So yes, Wednesday will be the most important one. I think all markets will be sort of focused and looking towards the FOMC decision Wednesday evening, and that's where we might see a lot of the drivers taking place. Okay, that's where we might see markets really moving off for the next 2 days thereafter in the direction as expected, based on the outcome there. Now, looking through, if we look at euro, go back to euro. So we could see euro trading within the range, euro dollar trading within the range, especially coming into the FOMC rate decision on Wednesday. It's bounced off those parity levels, right? So the one figure. Okay, so it had a false breakthrough, and that's where we then garnered some strength, and then we had the ECB come in with that 50 basis point rate rise, which led to markets recovering back to 1.02. Okay, 1.0220 through up to a high of 1.0280 handle. But it may stay in this range for some time before we have that the Fed come into place as well. Yeah. Now, on the other side of it is other economic data that you need to anticipate or expect for the week ahead. Well, the main focus is going to be we're going to have German IFO surveys and CPI data, especially from sort of the Eurobloc area, right? We're going to have US consumer confidence, US durable goods and personal consumption expenditure, so the PCE data, are sort of the key standouts in addition to the FOMC rate decision. Yeah. And then, of course, switching back to microeconomic view is earnings season is in full swing, right? So earnings season is in full swing. So we have some big tech will be in focus this week as well. So we'll have earnings from Microsoft, earnings from Alphabet, from Meta, Boeing, Apple, Amazon, ExxonMobil, and P&G are all the big names that will be reporting for the week ahead. Okay, so usually it's either reported pre-market or post-market. That's one thing to just be aware of, and then you'll have a lot of pre-trading activity or post-trading activity taking place, and the market open brings in another dimension of volatility into those earning reports as well. But certainly markets are focused on earning reports as well. As I mentioned, with the Netflix coming in much better than anticipated, we saw a big bullish drive last week at the beginning of the week, even though we turned around towards the end of the week on the Friday. Okay, so as I mentioned, so the key points there is obviously the Fed for the week ahead. So they have a 2-day blackout meeting, Tuesday, Wednesday, and then Wednesday, 7 p.m. UK time, we'll find out whether they raise rates in line at 75 basis points or they get ahead of the curve, ahead of market participants, and do a full 1 percentage point rate rise. And then we have these reports from these key earnings, and that's what's going to be driving those markets. Okay, that's the sort of the key focus for the week ahead. Okay, so despite a massive growth deceleration that we've seen in this year, which it may seem that the US economy is heading into a recession, right? But we do feel that the Federal Reserve are getting closer to being able to avoid that recession and not get into a hard landing and maintain a soft landing, as we can see right now. But it's going to be a very close call. It's going to be a very close call. Okay, so that's the sort of the key point that I want to take away from there, is that even though we're seeing rate rises continue to be the key rhetoric and the key tool to be being used to reduce inflation, and inflation coming in still at these highs, we're not seeing a more negative turn in the equity markets. We're not seeing more drives lower, more of a fall taking place or breaking prior lows. We're seeing consolidation now. So that may sort of indicate that, okay, we're not looking to fight the Fed. We don't want to fight the central bank. If the central bank can and give us that indication of a soft landing may be possible, right? That's where we might see a bottom being formed and markets begin a bit of a bull rally. But again, things can turn very quickly, especially in these current market conditions that we're in. So something to look towards is, of course, not just the interest rates and where inflation is. That's a key driver, of course it is, but other areas as well that would be impacting the risk of recession. Okay, so we know that over the weekend there was apparently Russian strikes, not officially sort of confirmed, but there's the suggestion of Russian strikes in Ukraine, in a Ukrainian port known as Odessa, right? Now, with those strikes taking place, there was a US envoy that was hit, as well as obviously Ukrainian ships. That port was a main driver of wheat, right? Shipping wheat around the world. So that's been taken offline, and it seems like Russia is maybe focusing on disrupting those shipments so that they can continue to cause this rampant sort of fear of potential famine for certain countries that have less wheat storage, right? So yeah, there is still a lot of risks ahead, right? There are still a lot of risks ahead. You should be mindful of the geopolitical concern that we're seeing, in addition to obviously inflation, and looking at what components of inflation is really rampant at this current moment, right? We now know that we're just looking back. We'll come back to the oil markets. Yeah, so oil's still trading back down to sort of these 95 handle. Okay, so it's just tested the 96 handle, just above the 96 handle, but there's certainly been a drive lower in the oil price. Okay, and we know what's taking place there, right? In regards to the SPR sort of levels are being used by the US to sort of bring the price of oil down. We know that there is some issues in Iran in regards to oil production being offline for some time, but I believe that they're coming back online again. And that's brought the price of oil down back to these key sort of support level that we've seen here. Another focus will be is, of course, gold. Gold, as I mentioned, that the chances of a soft landing is growing, right? The probability of a soft landing is growing, and it doesn't seem like we're going into a full swing recession, right? It's just the dynamics are changing in regards to that. And that's when we see now gold prices. Gold prices come back to that key level support that I've outlined to you a number of times after we broke those prior lows. This is a key sort of level of support that we expected it to be tested on the 1678 handle. And from that point, it pretty much come within touching distance of that support level, and it's bouncing higher. It's back up to almost testing the 1730 handle, reaching a high of 1740 on the recovery from those lows, okay? But again, we could see some consolidation as markets begin to price in the risks of a recession. So gold seems to be now holding that as a key level of support. This morning, European markets, if I just hit the refresh button. So yeah, this morning, sort of the European markets opening slightly bullish. UK 100 is opening, well, it's opening flat at this current moment. It's 60% there. Clearly, the German DAX and is massively impacted by what's taking place in the Eurozone area. So the euro and the euro equity markets, European equity markets that we're seeing are certainly in more of a risk of a recession with the likes of what's taking place in the Eurozone area. So it's made that low, which is around the 12,431 figure. It's retraced back up to the key level resistance, around the 1328 region. And now the question is there going to be a new low being formed, right? Are sellers going to step in and drive it lower? Okay, that's sort of the key question there. So look to trade within that support and resistance level. It's not quite broken those prior highs, so we are still in a bear market. You've got to see this still as a bear market. It's made that prior low, test the prior low, come up back to the recent resistance levels. We're seeing a bit more selling pressure coming in at the start of the week. But hey, it could very quickly change that dynamic, right? The FTSE 100, as I mentioned already, made a new low compared to the prior low, which was back in 11th of May. But it's been consolidating in this region for some time. It's been consolidation in this region for some time. So we do know in regards to the political risks that we've seen that came through from last week. Well, firstly, we know from last week's UK politics that it's fallen down to two individuals, Rishi Sunak and Liz Truss, right? It goes down to them two. They've gone into summer recess. Last week, Thursday, they went into summer recess, which means that they generally go back to their constituency and manage sort of the day-to-day sort of operations there, really, right, of their constituents. But then in addition to that, for the next few weeks, what we're going to find is that Rishi Sunak and Liz Truss, they'll be, looking to carry out rallies. I know that Rishi Sunak has a London session that he's doing on Tuesday, and then towards the end of the week, he's doing another sort of speech somewhere in London as well. And that's just to rally Conservative members. Now, within the Conservative members, there are 160,000 members. So it will be down to them to vote who they want to put into place as the next PM. And, so far it first switched over to Liz Truss in regards to surveys being carried out by media. It's at the moment Liz Truss is ahead, but it's all about the key policies that they're looking to sort of put into place, right? So we know that Rishi Sunak's going down the line of, I want to be honest, I want to gain trust, and I'm telling you that we have to take the harder line than we, to tame inflation and to leave a better economic condition for the future generations. That's his sort of overall sort of overarching view. Whereas Liz Truss is, no, I want to fight inflation by cutting taxes, right? So she's going with hopefully which could be a quick fix, but is it a long-term solution? That's the sort of key question there, right? And that's a difficult one to really forecast it. It will not always be the right decision to make, is to cut taxes, right? But hey, cutting taxes does ease market conditions enough to allow the cost of living to be at these levels, but sentiment still is positive and can boost the economy, right? And that's a short-term fix, right? But yeah, let's see sort of who wins out in regards to that. I know that over the weekend, Rishi Sunak mentioned that another sort of key mandate that he's brought in, will be bringing in, is reducing NHS sort of emergency, the A&E sort of type of waiting period. If you go to the emergency sort of any sort of emergency element of the hospital, and there's very long queues. I mean, these queues have been well known in the UK sort of economy, that it could be for hours. You can wait for hours to see someone. So he's looking to reduce the waiting period in regards to emergencies at hospitals. Okay, and then we're going over to sort of the Euro sort of political focus as well, and that will be mostly around Italy. Okay, so we now know that the 5th of September is when the decision will be made for the next UK PM, and it will be the 25th of September when we hear the next PM in Italy, right? And Mario Draghi, who was the ex-chairman of the ECB, well regarded in both from an economic standpoint and political standpoint. He had resigned. He was unable to have a coalition party appointed, and therefore he had resigned. And there is a government sort of debt crisis beginning to emerge. Okay, and that's why we heard from the ECB last week implementing a new tool. Okay, now the markets didn't take that new tool into much consideration, as they didn't really expand and give us the as they didn't give us the sort of the details we wanted to know about that. So again, one of the things that you could look to research this week is, what is this new anti-fragmentation tool that they're sort of regarding, and how will that come into play? Okay, so yeah, from a political standpoint, let's see what happens both in Italy and UK politics as well. Coming over to, let's have a quick look at the crypto space as well. So it seems to sort of reach those highs, and now we've seen a bit of consolidation coming into place, right? But with the BTC USD, Bitcoin is beginning to made a very strong new high, coming back to sort of test the 24,000 figure before it's coming back down to around the 22,000 figure. Okay, it is making lower lows and lower highs. Now the question is this from this swing high, is this the what you call within the Elliott waves, the ABC move, right? So the mark down before we have the next mark up, right? The next leg higher, and that's sort of the key point there. So I'll be looking for consolidation around this region where we are, where it was previous levels of resistance as well, and see if it sort of holds that level. Again, with ETH is consolidating sideways, so it seems to be within the range of support and resistance. Again, put in your support level, resistance level, wait for the breakout, or trade within the range. That will be sort of the way to go forward. In regards to news, I don't see any much news coming out in regards to the crypto space. But yeah, just keep an eye out on incoming information, not just in the crypto space, but of course, there's a lot of macroeconomic data to be focused on. But most importantly, earnings. Earnings is going to be highly regarded as an important area for market participants to view whether conditions can improve for corporations in the current climate we're in, which could lead to a soft landing being regarded and in line with what central bankers are expecting. So we could see a bit of a lift off and the lows being put into place. But again, it could pivot to the downside just as quickly as we hear worse earning reports coming through, as well as sentiment now begins to take in what to expect 3 months from now, 6 months from now from earnings as well. Okay, I think that's a broad roundup of markets from last week to this week and what to expect for the week ahead. Thank you for joining in this session. This is another weekly market analysis, and I wish you a happy trading week. Take care. Bye-bye.